Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah.
Good morning, I'm Ira Dugal. Let's get straight to the headlines this morning. Angela Merkel's bid to form a coalition in Germany collapses, the euro slides. Come December 18th, only two pharma stocks will remain in the S&P BSE Sensex as IndianOpen Bank and Yes Bank replace Cipla and Lupin. Eris Life Sciences enters into a definitive agreement to acquire Stride's branded generic business in India, 500 crore deal. Expect bond yields to fall this morning after the RBI calls off a 10,000 crore open market bond sale, citing evolving liquidity situation.
Well, that would be top, bro. I'm sure Ira will talk in detail about that. But just first a quick check on what the trade setup of the day looks like, how the markets are likely to start off. Well, a flattish start is what the global markets are indicating. Maybe a marginal downtake. And that's probably coming in from how the US markets traded in Friday's session as well. So the global markets, a tick of red across the bourses. The SGX Nifty indicating a bit of a downside as well. So we will start off on a slightly tepid note. The question mark is what happens during the course of the day, and that is difficult to be seen. The green shoot, if you will, is that foreign institutional investors had a reasonably large buy number sans bulk deals in Friday's session. That is not to say that those numbers would continue, but you were looking for cues on Friday's session. We had mentioned that we'd be really surprised if there is not a buy number that comes in on a day like that. So even though the markets ended off the day's highs in Friday's trade, a bit of a buying that is coming in the cash market, and the FNO side as well, some bit of long formation that happens. Very, very minuscule, but some bit of long formation that did happen in Friday's session. What will be top of the mind? I think a clutch of names that will be in focus this morning, aside of course, the bond markets, which I'm sure Ira will talk about. But if you just look at all the key changes that have happened and all the key stocks in news that have happened, you'll probably see IndianOpen Bank and Yes Bank being in focus, as would be the pharma pack, with Cipla and Lupin exiting the Sensex, and IndianOpen Bank and Yes Bank joining the Sensex. Now, you know that a lot of foreign funds keep the Sensex as a benchmark for their investments as well, passive funds. And this may be very, very interesting for these two names. So we'll do some calculations as to what happens in terms of buying and selling on these stocks. Speaking of stocks in focus, look at the cement names. There are two pieces of news. Shree Cement, JK Lakshmi Cement, JK Cement are amongst the stocks that will be in focus because the Supreme Court has rejected the plea on revoking the pet coke ban. So these companies should be in focus, as should the cement price rollback, bring almost the entire sector in focus, because news reports suggest that prices have been rolled back to September levels by ACC and Ambuja in certain pockets, but this may well keep that sector in focus, may well keep the space in under pressure as well in the session today. So do watch out. I think a very big deal, and we'll talk about that. A reasonably sized deal, but an important one for Stride Shasun. They've entered into a definitive agreement. Have sold the India formulations business to Eris Life Sciences for 500 crores. So do watch out for that. And amidst tepid order inflow guidance for the second half, L&T wins a reasonably large order to build the Mumbai Trans-Harbour Link. It doesn't do too much for their overall portfolio size, but it's a large order win, and that should keep this stock in focus in the session today. But Ina, big news in the bond markets as well today.
It came through on Friday. Just bring up the 10-year bond deal, and we'll start by explaining to you what exactly was going on Friday. Remember, Friday early morning, we had got the Moody's upgrade of India's rating. So you'd seen bond yields come off very steeply, as you would expect them to. So you were trading at about 705 when you went into that news. That was on Thursday evening. You came down all the way to about 695 or so. You had a 10-year, you had an auction, you had a normal government bond auction. The 10-year paper in that went at a yield of about 6.97, which was fine. But then towards the end of the session, you started to see bond yields climb back up. Now, there are various versions of what was exactly happening in the market. Some people say it was technical factors at play. Some traders were being excessively bearish in the market. But net, you had seen bond yields start to climb back up above 7 and then go back towards 705. That's when the Reserve Bank of India, after close of trade, said that they are pulling off their open market operation for the 23rd of November. That was a regular 10,000 crore open market operation that had been scheduled. So the RBI pulled that out, and in their explanation, they said that they had pulled this out on evolving liquidity conditions plus also volatile conditions in the market. Now, remember, if you think back to the last month or so, we've been talking about how liquidity situations have turned in the market. They're not as surplus as they used to be, and that was pointed out just by the fact that growth in deposits was at about 9.2 and growth in credit was at about 7.2. So the differential between deposit growth and credit growth was narrowing, which means that incrementally liquidity was tightening. The market had been going on and on saying that the RBI needs to now pull back on their open market operation bond sales because those were intended to take care of that surplus liquidity situation, which no longer exists. Well, finally, the RBI seems to have taken note of that, perhaps driven by the slightly sort of inexplicable surge in yields on Friday trade. But you should see some relief on bond yields this morning. Where they settle is the next point, and you would want to wait for 2 or 3 days to see where the yields settle, probably around 7-ish or so.
Well, that's interesting. So the bond markets have been in the thick of news, quite frankly, over the last couple of days. But today on First Word, let's tell you all that we'll speak about, aside of course the trade setup and the bond markets as well. The financial sector is set to gain prominence on the Sensex at the cost of the pharma sector. We'll talk about that. There is also another deal that has been inked between Eris Life Sciences and Stride Shasun, so pharma firmly in focus. We'll also talk about what's in it for both the companies. The Indian civil aviation sector touched a magical 10 million flyers last month. So which airline gained, who lost out? We'll also look at the complete analysis and take a look at the investment trend adopted by mutual fund houses in the month of October and some very interesting data points out there. But first, the Bombay Stock Exchange will reconfigure the constituents of few of its indices from December 18. The weightage of pharma stocks will fall on the Sensex, while private banks will gain. Let's get in Darshan Mehta, who joins us with a complete analysis of what's making the cut and what's not. Darshan, good morning.
Yeah, good morning, Neeraj. So basically, Cipla and Lupin will be out. What will enter will be IndusInd Bank as well as Yes Bank. Now remember, Sensex has just 30 stocks, so the room for getting in stocks is much lesser. All 4 of them continue to be part of the Nifty. Now, weightage is not the highest. Cipla has a weight of 0.84%. Lupin has a weight of almost 0.65%. Now, let's take a look at how the performance have been in the companies that will exit and will come out. So Cipla has moved up on a YTD basis just 7%. Lupin has been a marked underperformer, down 44%, while IndusInd and Yes Bank have done reasonably well, almost for a large cap like them, very well in fact, 47% and 32% move that has come in. And look at the market cap also. Now Cipla market cap is almost close to 50,000 crore. Lupin, from a market cap of in excess of 1 lakh crore, has fallen to 37,500 crores. It was the second largest pharma company in India after Sun Pharma in terms of market cap. Now pretty much it will be the 5th or the 6th largest company. IndusInd close to 1 lakh crore and Yes Bank close to 70,000 crores. So no doubt the heavyweights and the performers are coming in. But the problem now is that the weightage of banks has increased substantially in the Nifty, especially in the Sensex and the private banks. So what remains in the pharma are only Sun Pharma and Dr. Reddy's Labs. So the weight of pharma has come down drastically in the Sensex, and the weight of the private banks so they will be part of the Lupin. Cipla and Lupin will continue to be part of the Nifty. As far as banks are concerned, let's look at the private banks which are part of the Sensex. So there's Axis Bank, there is HDFC Bank, there is ICICI Bank, there is Kotak Bank, there is HDFC. So significant amount. With these two coming in, the weight of the private bank sector goes up significantly as far as the Sensex is concerned. Also some rejig in the BSE 100. So these are the mid caps that are coming in. So UB, SAIL, Canara Bank and Reliance Infra go out. Federal Bank comes in, Grasim comes in. Grasim was initially part of the Nifty, went out because of the scheme of arrangement. Vakrang is very interesting, recently got included in the MSCI. And Bajaj Holdings, very interesting name that comes in. Also some changes in the BSE Sensex 50 stocks. Ambuja, Aurobindo and Bosch go out, and Grasim, Hindalco and HPCL come into the Sensex 50 now.
That's interesting. Thanks a lot for that, Darshan. But hey, Ira, this points towards, if for the longest time, I remember 10 years ago or 15 years ago, the talk used to be that if you buy oil and gas, you're buying a large portion of the Sensex or any other sector. But never before, at least to my living memory, have we seen such a disproportionate high weightage of a particular space, and I'm using BFSI as an example, not just banks, being so high on the index. It's almost like one of those global markets wherein a commodity-based market wherein you buy that sector and you're buying that market for that matter. Or this year, if you bought Samsung, you bought Korea. In the same way, if you buy banks now, you're essentially buying the index because net, sentimentally, they could well be 40-45% of the total weightage.
But you get to play on various things via the banks, right? I mean, so if you're not confident about the infrastructure companies, but you think that the infrastructure cycle is going to pick up, you can buy corporate banks. You've sort of, you've diversified that way how you're actually playing that. Similarly for consumers, you may not be, thrilled about buying FMCG or consumer durables, but you buy a consumer-driven bank like HDFC or a Kotak, you get a play on that. And at the end of the day, it's the multiplier, right? The multiplier between GDP growth and banks has not held true for the last 2 years because of this whole problem. But you have a 2.5 times multiplier to GDP generally on, in terms of credit growth. So as things start to normalize, this, bank bad loan problem goes away, your GDP goes up to 7.5-8%. Banks would grow at least 2.5 times, unless that multiplier has changed for, a long period of time, which would be surprising. There's no reason for it to have changed. So I mean, it's, and actually somebody was making this point. This is not my thought, and I can't remember who on Twitter had made this point. I think it was Anupam Gupta, who I think is a market expert as well, and he was talking about how BFSI has changed. There was a time when BFSI was largely banks. Now BFSI is NBFCs, insurance, capital markets, AMCs, and banks.
Yeah, that's true.
I thought that was a very perceptive point, that BFSI is now actually BFSI as opposed to just banks in the guise of BFSI.
Yeah, representative of more than just pure play lending mechanism.
Yes.
Yeah, that's interesting. Okay, but well, that's not all. Pharma too in focus today for more reasons than one.
Yeah, I think weekend deal coming through. Darshan's still with us. Eris will acquire the Indian branded generics business of Strides in a 500 crore all-cash deal. Darshan, you want to run us through what brokerages are making of it this morning?
Yeah, clearly. So as far as the deal is concerned, it's not the largest, but remember there's significant amount of consolidation, because almost 15 days ago you had the Unichem Torrent deal that happened for the India business. So this deal is not as big as a 3,600 crore deal, but the Strides deal is of 500 crores. No share swap. It's a 500 crore cash that will happen, and the valuation is at almost 2.8 times EV to sales that has come in. So not the best of valuation, because it's the India business of Strides has not been able to grow. Now significant amount of money needed to be put in by Strides to actually get this get this business going. It's a single EBITDA business, very low margin business compared to what they had, and they had to put in significant amount of money to get this going. So instead of that, it was a better deal for Strides to actually sell off the entire business for 500 crores. And brokerages do indicate the fact that it's a good deal, given the fact that Strides will now will actually focus more on their existing core business, that is US and Australia. No doubt the debt will come down significantly by 400 crores. Out of the 500 crores, 400 crores will be reduced, will be used to reduce debt. But more importantly, the India business of Strides will actually was basically on account of a lot of acquisition. So the amortization that they paid, interest on amortization that they paid, was significantly higher on these companies. So that will go down, and there will be an interest cost saving of anywhere between 25 to 30 crores per year. So Macquarie has come out with a note, JM Financial has come out with a note on Strides, and all of them do indicate that it's positive for Strides, given the fact that they are getting rid of a low margin business, and they will be able to reduce their costs. For Eris Life, obviously it's a positive deal. They're getting a business at a low valuation because the business was not doing well, and they're basically India focused, so that will help them increase their space in the CNS segment and the India chronic segment significantly.
Okay, Darshan, many thanks for that. So do watch out for these names as well in trade today, early morning. Well, that's not all really. Now we look at trends. I mean, we looked at the pieces in news. Remember, there is also Larsen and Toubro, and we'll get the management a bit later on to talk about the large order win that they have had. But now we tend to look at trends, and two trends that we want to speak about. Firstly, air traffic, because domestic air traffic in India is seeing a steady growth. Passengers cross 10 million for the second time this year. And while this news came out during market hours on Friday, we're trying to do an analysis on some data on which airline is faring better and at whose cost. Sumit, is that somebody win and somebody losing out, or are all benefiting?
Well, it is somebody winning and somebody losing out, because it's 100% market share. If someone is gaining, someone
is a big change?
It's not a big change, but a significant one, I would say. So in the month of October, more than 10 million passengers flew in the domestic airlines on the back of major festivals, including Diwali, and because of the competitive fares that the airline companies brought in. Now, since April 2014, only 2 times the total domestic passenger number has crossed the 10 million mark. First in the holiday season of May 2017 and now in October 2017 that it has crossed 10.5 million mark. Now let's see the passenger growth. Now compared to the last year, passenger growth was 21% in the month of October, which is the highest since January 2017. Now, since February to September, the passenger growth was hovering in the range of 15 to 17% with exception of June. And now in the month of October, it has crossed the 20% mark. Now, let's see the company-wise growth data. Air India and SpiceJet saw the highest growth. SpiceJet's passenger growth was around 27.3%, while that of Air India was also 27.3%. For Air India, it was the highest in the last 13 months. Jet Airways passenger growth was 20%, highest in the last 2 years. However, for Indigo, the passenger growth was only 11%, which is the lowest in the last 3 months. Now coming to load factor, which shows the capacity utilization for an airline company. Now, this grew for all the top 4 companies. Indigo's load factor stood at 87.3%, higher by 240 basis points compared to last year. Jet Airways passenger load factor increased by 800 basis points to 81.3% in the month of October. Now, SpiceJet's load factor grew by 180 basis points to 93.7%, and this was also the 30th consecutive month where the company has posted a load factor of more than 90%. While for Air India, the load factor grew by 480 basis points to 76.6%. Now, coming to the market share. Now, in the month of October, Indigo's market share rose to 39.5%, and it was the highest compared to all players. Along with Indigo, it was Go Air and Air Asia which saw an increase in market share. Now, Go Air's market share stood at around 8.8%. It increased by 40 basis points, while for Air India, it increased by 20 basis points to 4.3%. On the other hand, Jet Airways, SpiceJet, Air India, Vistara and for other players it was same at 0.5%, while for Jet Airways, SpiceJet, Air India and Vistara the market share declined and it was gained by Indigo, Go Air and Air Asia in the month of October 27.
Hey, Samit, I just have one small question. If I looked at the passenger growth numbers, they were the best for SpiceJet and Air India if I'm not wrong.
Yeah.
Indigo didn't have the greatest passenger growth numbers.
It didn't have the greatest passenger growth, but it still maintains the market share.
It's actually gained market share in the month of October.
Yeah, but that is because of the growth in passenger load factor.
Right. And my second question to you is Indigo had a low passenger growth number, right?
But it was it grew by 240. Passenger growth was lowest, but
load factor went up.
Okay. Last question: was Indigo able to reverse any of that lost ground due to the grounded planes issue that it had in the quarter gone by in the month of October?
Most of the grounded plane issue was in the second quarter. That was until September. In
Precisely.
October, it was not much.
Did it reverse? Okay.
Yeah, it did reverse some of it, and that's the reason you see a growth in the market share also, because the market share in September was a bit lower when compared to the previous months. So they have reversed that trend now.
Wow.
Impressive numbers there. That's the aviation market. Thanks so much, Amit. Getting you the data, monthly data, aggregate numbers looking very good, and within that, what the breakup looks like. Speaking about the breakup, what is the preferred investment for mutual funds? October data out, Neeraj, suggesting some shift in patterns?
Yeah, so, well, significant one. And you have to credit Motilal Oswal for doing this report. So I'm taking excerpts from that report and bringing out the key things that I thought stood out. So AMCs in the month of October, they increased weightage in PSU banks. Wouldn't be surprised. 25th October, I think, led to that. Oil and gas had a bit of an increase, and we've seen buying in, certain companies like ONGC and some of the others too. And telecom had a bit of an increase. And then there were some of the others like consumer, infrastructure, real estate, etc., where the weightage went down. Private financials, that's very, very interesting. And I'll tell you why it's very interesting also because of the second part of this discussion. Technology came off and came off quite rapidly, and metals, the weightage came off a little bit. Jayesh has been talking about how these individual AMCs have done, and you could have gauged as to what could have happened for the overall basket. Now, look at this. One, technology. We've seen technology stocks starting to lose out in the last 2 or 3 sessions as well. But the first fortnight of November seemed to be a good one for technology. And the reason why it's important, because the overall weightage of technology over the last 1 year is off by 120 basis points. For the sector, the weightage to come off 120 basis points would mean a lot. One, the price correction. Two, the selling that institutions, mutual fund institutions would have done in that ensuing period for the weightage to go down 120 bips. It's 9th on the sectoral allocation versus 5th. So technology as a pocket, a large pocket, very well governed on the corporate governance front, etc., etc., etc. It's 9th on the sectoral allocation front. So there's a big shift out of technology into other pockets. Now look at banks. Mutual fund stance on State Bank of India. The allocation in October, only October, the value of State Bank of India increased 3,280 crores. Now part of this increase would be because of the stock price movement, but part of this increase would also be because people would have gone and bought into SBI, and we've seen that evidence of that, because while a lot of other PSU banks, after that initial big jump, came off from the levels, from the 25th October levels, SBI has only gone up from those levels. So, and 14, and this has happened despite 14 out of 20 fund houses being net sellers. That's the interesting bit, because while people bought in on 25th of October, the next day onwards, you would have presumed that some mutual funds came out and sold their positions because they thought that the price had gone up. You would presume that SBI and some of the PSU banks would have been bought into and people would have stayed put.
Yeah.
But hey, 14 out of 20 fund houses have been net sellers. Even if we assume that 10 or 9 or 8 out of these fund houses were selling before 24th October, there were a few who came in and sold post the event happening. Okay. So that is one. And two, despite the fact that private financials, the weightage has gone down, but look at HDFC Bank. The allocation in October, 14 fund houses were net buyers of the stock, which is arguably the most expensive banking stock. And in an area wherein private financiers' weightage has gone down, HDFC Bank has only gone up. So that's really interesting. I mean, the third is Coal India, and people don't like it. So 13 fund houses were net sellers, value decreased by 340 odd crores. So all of that is okay. I mean, it's in the thick of things because of the news flow, Coal India, and the whole issue. But it's essentially about banks, and very interesting about HDFC Bank in particular.
Okay. Neeraj, I think news coming in. We're just going to cut short your chat a little bit on Biocon. Darshan is standing by. I think there's some change in status on one of their plants. Darshan, can you give us the details?
Yeah, so basically this is the Bangalore plant that was there, which was facing immense amount of pressure. Initially, there was significant amount of observations by the French authority and then by the US authorities. Now, on Friday, there was this news, there was this report by Aquarius, which had indicated that the company, that the US FDA had moved Biocon's plants to a VAI, which means that there was the chances of them getting an import alert or a warning letter drastically reduces. Now Biocon has come out with an official release indicated that the US FDA has closed the audit and given them the EIR, which means that this plant is a go. They can go ahead and sell out of these from this plant. Basically, some of their biggest, one of their big biosimilar, that is Herceptin, was from this plant, and because of this, issues will be closed for Biocon. So expect Biocon to open gap up in trade today. Extremely positive news coming in for Biocon today.
Darshan, just one small clarity. I remember Biocon caught in the thick of things about 3 months ago, wherein people were attaching timelines. They had gotten some extensions for inspection. Was that for the same plant?
Yeah. So this was basically for the Bangalore plant, the sterile plant that is there. And there were 35 observations by the French authorities. There were 8 observations by the US FDA. And that is something now has been cleared by the US FDA. Should be extremely positive for Biocon going ahead.
Wow. Okay, thanks, Darshan. We'll leave you to do some more analysis, but clearly Biocon could well turn out to be that pharma stock of the morning, while pharma is having some bad news today in terms of 2 heavyweights moving out of the Sensex. There are some newsmakers as well, with Eris and Strides, as well as Biocon being the big one. But that's all that we have on First Word. But stay tuned to Bloomberg Quint as we have some very interesting discussions. Kenneth Akinteve of Aberdeen Asset Management would be joining in to speak about whether India is back in favor amongst FIIs post the upgrade. And we discussed the discount broking business with Prakash Gagdani of 5 Paise Capital. And next up, let's get and of course we get the economic scorecard from Sajjid Chinoy of JPMorgan. So that's the very interesting discussion lined up a bit later on IndianOpen as well. But for now, full tilt towards the day's trade. Let's take a quick check as the derivatives pocket. Navneet Sajjid is standing by with the FNS setup. Navneet, good morning.
Hi Neeraj, good morning. Well, the SGX Nifty this morning is suggesting a downtick of almost 20 to 25 points. But if you have to go by the cues of Friday, clearly there was some respite seen, but there were no fresh long build-up seen on Nifty futures as the open interest was down nearly 1%. But have a look at Bank Nifty, which touched its record high levels on Friday. I feel it's going to be in focus today as well, because there were some fresh long positions being built up for Bank Nifty, where the open interest surged nearly 6%. Let's just pull up the intraday chart of India Volatility Index. Remember, we had a gap up opening, but there was no incremental buying which was seen on Friday. And the India VIX will clearly tell you we opened gap down for India VIX on Friday. But towards the end of the session, there was some bit of recovery, and finally it closed with gains of nearly 2%. In terms of options data, well, the base on the downside has once again shifted to 10,000 strike for 10,200. But clearly, the call writers ran for their cover. The 200 and the 300 strike saw some bit of unwinding coming about, and heavy put writing was seen for the 10,300. So probably that's working out as a base. Remember, there's expiry next week coming about. What did the FIs do then on Friday? On a big day when there was ratings upgrade, they built up little bit of long positions on the index futures, but there were bit of shorts also seen. Net, there was net long build up, but remember, overall positioning still remains 50% long and 50% short, whereas on the option side, we did see buying coming up for the put longs, and also there was writing seen here. So clearly on the options data, the positioning is they've bought more of puts and clearly they've written more of calls. So net on the option side, the FIs are still short. In terms of stock futures, there are 3 stocks which are new into the F&O ban: DLF, HTIL, Indocount. Remember, all these 3 stocks were highlighted for you in Friday's closing show. And India Cement is out of the F&O ban. That stock was up nearly 2%. And also keep an eye on Just Dial. That counter saw maximum build-up in terms of open interest addition, and it was also up nearly 5%. So let's see if there is any fresh buying which can be seen in this counter today.
Okay, thanks a lot for that, Navneet. Abhijit Phatak, Director at Definite Solutions, joins us right now on the show. Abhijit, since we're on the topic of Just Dial, let's start off with that first. Some long build-up that we saw. I don't know how closely you looked at the F&O positions in Just Dial, but clearly it saw some buying and some long formation as well. Any thoughts?
Yeah, Just Dial has been bullish right from, last 3-4 weeks. And I was looking at a close above 550, which it gave on Friday. And as long as it is above 550, it can go towards 580. It is looking very bullish on charts.
Okay, but have you seen some long build-up on the F&O side as well? And would you buy the futures this morning, Abhijit?
Yeah, it depends on where it opens. If it doesn't open too much of a gap up, if it opens around 550, 555, 550 or 548 is a good stop loss. It depends on where one can get an entry. There's no point in taking an entry, let's say at 560 or something like that, because the stop loss goes far away. So it depends on where it opens, and if you can get an entry between 550, 555, then it is a good entry with a stop loss of below 550.
Okay. What about the index, Abhijit? What are you doing there?
Nifty actually on the big gap up day on Friday hit resistance, almost traded open within the first half an hour near 10,350. And unless that is crossed and decisively crossed, building longs at that around those highs is a bit risky. And I would wait for a drifting down or correction towards 10,250 on Nifty spot, because that is a good support. And as long as 10,240, 10,50 holds, one can go long again for a target of 10,350 and wait to see if it crosses, because this range of 10,240, 10,250 to 10,350 will be, I expect Nifty to be sideways with stock specific action for the next couple of days.
Okay. And you have a call on Equitas, Abhijit?
Yeah, Equitas looks like it has bottomed out, and if one can get near 140, 141 futures, that can be a good long with a stop loss of 138. And I expect it to go to 143, 144 maybe intraday, and above 145 close it can go towards 147, 150 also. It can be a good trade in futures.
Okay, so good trade in futures could be Equitas. Do watch out for those levels though. I think Abhijit clearly mentioned that if you get it at a particular level, 140, 141, if I'm not wrong, is when you can go out and initiate a long position there. A stop of 138, a target of 144, 145 odd. Abhijit, thanks so much for joining us this morning and giving us your thoughts. Let's move on to the commodity space. Pradeep Johnson to talk about that and to take the show forward. Pradeep, good morning.
Good morning, Neeraj. So let's look at crude first of all. This morning in electronic trade or Asian trade, crude is actually flat. That is after rising on Friday. So Saudi Arabia actually indicated that probably the doubts that Russian comment had created were not called for, and OPEC and non-OPEC countries will still reach at an agreement to extend the production cut by another 9 months or so. Actually, Russia kind of hinted that it was very unlikely that if prices stay at 60-65, they will agree to the extension. So that is still interesting and is a developing story, and markets are kind of trying to understand and react accordingly. Gold prices, on the other hand, hit a 1-month high on Friday. Actually, funds have raised their net long positions in COMEX, gold and silver. That's the this revealed by the data released by the U.S. Commodities Futures Trading Commission on Friday. So funds are buying gold, and so gold inched up a bit, still short of $1,300 though. If you look at gold prices in India, they are actually trading at a discount for the first time in 6 weeks. That's interesting, which means probably that wedding season has not been going that well for Indian jewelry companies, probably. Well, talk about other commodities. Sugar ended higher for the second day. On LME, base metal index posted a second weekly loss on Friday. This morning in Asian trade, copper and zinc are trading higher for the second day, Friday and Monday. And steel is trading lower for the fourth day. So that's the update on commodities.
Well, a quick check on what the Asian markets are doing as well. Flattish is what the SGX Nifty is indicating, so do watch out for that level. However, I think what's in news is cement plants in North India have run into rough weather. The Supreme Court banned the use of pet coke in the region. I think the ban was probably there, and the Supreme Court has overhauled or overturned a plea to revoke that, if I'm not wrong. But Nikhil is here with the latest of what the news is, and very quickly all the companies that will get impacted. Nikhil, good morning.
Hi, good morning. So the pet coke, Supreme Court has clearly disposed the plea to relax the ban on pet coke for 3 reasons. That is Haryana, Uttar Pradesh and Rajasthan. Remember, this ban was now first extended to Delhi and just the NCR regions. Now it's been completely imposed on the all 3 states. Also, if you see the state, it's suggested that other states should also consider this move, given that the pollution-related problems are just not NCR related for that matter. It plans to hear the appeal coming in from the cement companies. The ruling is due next on December 4th, and north-based companies that we understand, we spoke to a few management of companies and understand that they're expected to appeal against the order. The impact of this is going to be felt the most by the northern players, be it Shree Cement, JK Lakshmi Cement, JK Cement, or for that matter even the northern operation of pan-India players, Ambuja, Ultratech, ECD. They all stand to get impacted by this move, and other states may also follow suit, which means that we might just be looking at higher cost pressures coming in, since the companies of these could move from using the pet coke to international coals as a % of their power fuel consumption, which tentatively is expected to be on the higher range, and this may actually escalate the power and fuel expenses more by at least 10 to 15% as per the Kotak Securities report. IDFC Security has a little more aggressive target. It says that the hit could be at least in the range of 20 to 25%, at least in terms of the power companies' power and fuel expenses. It says Shree Cement has 77% of the company capacities which will be impacted, and the power and fuel costs will be expected to rise as much as 20%. Ultratech and ACC and Ambuja Cement comparatively will have a lesser mode of capacity there, so they stand to be impacted a little less than what northern players will be for that matter.
Thanks, Nikhil. Let's talk about that with Prashant Bangur, Joint Managing Director at Shree Cement. He joins us right now on the phone line. Thanks so much, Prashant, for joining in. Do confirm this development. As we understand, the ban has been extended to Haryana, Rajasthan and UP in addition to Delhi. Is this information correct?
Thank you so much. Yes, of course it is correct. The Supreme Court order is in the public domain. So they have extended the ban on the use of furnace oil and pet coke for the whole states of Rajasthan, Haryana and UP.
Okay. So what would this mean? Because and please tell us what the future course of action would be, because we spoke to a few gas companies who had said that if this ban does get extended, then for example Indraprastha the gas, and the gas would be used in absence of pet coke. What does this do in terms of operations for a company like Shree Cement, wherein a large portion of your capacity, I presume, would be using pet coke, and what kind of cost differential?
Of course, so we'll have to change the fuel. We will no longer be able to use pet coke in the cement and the power side. So we'll have to switch to international coal. As per cost, your estimate about 10 to 15% is more rational than about 20%. The cost is expected to go somewhere in the range of 10 to 15% per ton.
And how smoothly could you really carry out this, transition?
The transition will be a one-day affair, because the plants are designed to be multi-fuel, at least our plant. So we'll not have any problem switching over from pet coke to coal.
And what kind of cost escalation does that mean for you?
cost escalation is 10 to 12%, 10 to 15% when it comes to per ton of fuel.
And what would be the net impact on your margin?
So net impact on the margin again is very dependent upon the selling price of cement. Being a commodity is very difficult to predict. So we can really talk about costs in a much more confident way than we can talk about the impact on margins and the selling price.
Okay, Prashant, the reason why we're trying to probe this a bit, because typically, cement companies can have the option of passing on the costs as well. But just overnight or over the weekend, we've gotten the news that two of your peers, ACC and Ambuja, have rolled back prices to September levels as well. So the question is, would a company like Shree Cement, which is dominant in the areas that it operates in, be able to pass on this cost increase, or will you have to bear the brunt of pricing pressure at least for the October, November, December quarter?
So, like any commodity, the prices have to move in tandem. Otherwise, you just outsell. The competitor will outsell you. So, keeping that in mind, if and for any cost increase which takes place, there may be some lag between when the cost increase takes place and when we are able to pass it on to consumer. So, it may be true that October, December, we may not be able to pass. We have to wait for the demand to pick up, and if the market demand supply is balanced, then that is the right time probably when the cost will be passed on to the consumer.
Well, Prashant, one last question from my side. So this transition is the only option left, because coming from the apex court, does that really leave you with any judicial remedy? Have you consulted your lawyers?
There's always an option to go for a review petition with the Supreme Court itself, but that will be industry-wide consultation and decision. CMA will approach the Supreme Court on that behalf, on behalf of the industry.
Okay, Prashant, we'll leave it at that. Thanks so much for taking the time out and joining us, and wish you all the best for the quarter, of course. Okay, from one big newsmaker to another, Biocon, Kiran Mazumdar-Shaw joins in on the phone line, and Ms. Shaw and Darshan, of course, joins in to take the conversation forward. But just an opening question, Ms. Shaw, you must be very pleased with the developments.
Well, it certainly is a very positive development because this was an inspection that had raised a number of 483s. It had raised a lot of concerns. And, obviously we had indicated that we would present a CAPA plan and hope and work with the regulatory agency to work towards closure. And I think the fact that they have accepted this CAPA plan and have basically issued a VAI is very positive news indeed.
Okay. Good morning, Ms. Shaw. Great news coming in for you in terms of this plant clearance. The USFDA has given the EIR. What's the way forward now? Which are the products that are in the pipeline? What's the way ahead for trastuzumab and pegfilgrastim now?
Well, as you know, we got a complete response letter for pegfilgrastim. And, the agency had basically indicated to us that we would need to implement the CAPA plan and update our file and resubmit the dossier, which is what we are doing now. And hopefully we should, hopefully get approval within 4 to 6 months for pegfilgrastim. And as far as trastuzumab is concerned, obviously we are, keeping our fingers crossed for the 3rd of December. So all in all, this is a facility that makes all the biologics. It's an aseptic filling facility, and which is where we make the biosimilars and we supply these biosimilars to many markets.
Anything else that the US FDA has asked for you in terms of the target action date for trastuzumab on 3rd of December?
Well, during the review process, they do continuously ask you raise some queries which you have to respond to. So, now we are nearing that date, so hopefully we should hear from them soon.
Okay, just an update, the US FDA has cleared it, but there were some issues as far as the French authorities are concerned. Is that also closed or is that in the process?
Well, we have sought a re-inspection from the EMA. And as you know, we have resubmitted our dossiers for EMA to look at again. So hopefully even that will be reviewed, and hopefully we should get approval from EMA thereafter.
Okay. My final question, Ms. Shaw, is that with this EIR, are all issues with the US FDA now closed, or is there any pending issue with any of the other plants that Biocon has?
No, if you remember, recently we've had a US FDA inspection at our Vizag facility, where we received, in fact, no 483s, and therefore the EIR was an NAI, which is no action required. So we, at the moment, don't have any open issues as such with US FDA for any of the CGMP inspections.
Okay, just an update here for the benefit of the viewers. What happens, just for them to understand what happens next with trastuzumab? The target action date is 3rd of December. If you get the go-ahead, when will be the potential launch, and what kind of revenue targets are you looking at from trastuzumab?
Well, as I mentioned earlier, approval is one thing, but then market entry is another. And as you know, Mylan has entered into an agreement with Roche for a particular market entry date, which unfortunately I cannot share with you. But it gets us ready for that entry.
Okay.
Once we get into the market, obviously, then we look forward to garnering market share.
Okay. Thank you, Ms. Shaw, and congratulations on the development that has happened.
Thank you.
Back to you guys.
Okay, Darshan, thanks for putting that into perspective. Clearly, the pharma newsmaker of the morning. Let's talk about that and more with P. Phani Sekhar, fund manager at Karvy Capital, who joins us on the show as well. Phani, afraid jumping straight to the micro before we talk about the macro as well. But you just heard both the managements of Shree Cement, which will probably be under pressure today, and Biocon just right now speaking about. What do you make of this? Because for the longest time in the last 3 months, everybody believed that this facility will not be able to go ahead and do its best until the deadline passes. Now that has reversed. Do you think that gives a big leg up for Biocon?
Hi, good morning, Neeraj.
Good morning.
So, while that was an expectation in the market, but if you actually look at the valuations of Biocon, investors did look at the medium to long term, which means that beyond, say, maybe 2 quarters of not so favorable developments, one was expecting that from a macro biosimilars point of view, things will look up well. And the fact that it happened now is certainly a positive. While if you look at something like a Shree Cement, for almost close to a decade, and the valuations have been sky high. While I don't think that this recent development of petcoke not being allowed in cement manufacturing is really going to alter the landscape materially, but certainly it is certainly a cause for investors to I think reflect on these valuations, because most of those valuations can't be justified from any fundamental parameters. A lot of companies in central India actually are enjoying very, very elevated valuations. So I am quite positive on Biocon, not so much on cement. Disclosure being, I do not hold positions in either of these companies.
And I mean, you have already kind of pruned your exposure into cement, I'll understand with that, because you have been negative.
We never had great exposure in cement, Pradeep, because we were never comfortable with, the valuations, because the cement sector was reflecting more than fundamentals, a consolidation theme.
Okay.
Something that has started happening in telecom of late, right? As long-term portfolio investors, we were never really keen to play that theme. And this theme has been playing in cement for almost 5 to 6 years now. So if you look at fundamentally, right from volume growth to, the kind of EBITDA per ton numbers that cement companies have been throwing, I don't think they merit the kind of valuations they've been commanding. But at the same time, you actually saw certain consolidation happen on the ground. So it is for investors expecting a very different kind of risk-return game.
Okay. So we'll definitely ask you what exactly you like in this market. But before that, let's go across to our research team and find out which stocks are they really tracking. So we have Agam and Saloni this morning. Agam, to begin with, what are the key stocks and news that you're following?
Sure, Pradeep. So let me start off with Larsen Toubro. A very, very big project awarded for Larsen Toubro. This is with respect to the Mumbai Trans Harbour link, and this project is worth around 8,650 crores, so it could be a substantial uptick for LNT. We have updates on two very important buybacks in the IT industry. So Wipro buyback opens on November 29th, it will last on till November 13th, and Infosys buyback opens on November 30th and will go on up till November 14th. Of course, another very important development when it comes to the mid-cap space, Vadilal Industries. This time around, we understand from reports which suggest that one of its promoters is looking to sell its entire stake in the company. We will be looking out for more developments with respect to that. In terms of bulk deals, we're watching out for HDFC Life, where Nomura has bought around 1.92 crore shares, and Morgan Stanley has bought as much as 0.7% stake in HDIL, so we'll also be watching out for HDIL and how it moves in trade today.
Okay, and I thought result season was over, but looks like over the weekend there have been several results that have been announced.
Yeah, so I would like to highlight three companies which posted their second quarter earnings this weekend. So first up, we have Eris Life Sciences. The company posted good set of numbers. The revenues were up 25% at 250 crore versus 200 crore seen last year, while the net profit was up 35% and it stood around 93 crore. Also, the operating margins expanded 200 basis points and it stood around 40% for quarter 2 to 2017. Moving on to Mayur Uniquoters, the company posted muted set of numbers while the revenues were up 15% and net profit was up 7% at 140 crore and 23 crore respectively, while EBITDA margins were largely unchanged and it stood around 25%. And lastly, S. Chand reported weak set of numbers. The company reported revenues of around 17 crore, which is 40% down as compared to last year, while they posted a net loss of 10 crore, and finally it reported an EBITDA loss of 20 crore versus a loss of 15 crore seen last year. Pradeep.
Thanks, Saloni and Agam. So, Phani, out of these three, S. Chand, Mayur Uniquoters or Eris Life Sciences, do you like any of these mid-cap names?
Question is at me?
Yes.
Well, unfortunately, Pradeep, I'm not tracking any of the three.
Well, that's interesting. There's a news bit in Vadilal, and just before we get in our technical experts, Phani, there's a news bit in Vadilal Industries saying that the promoters may look to exit. The Economic Times is reporting this. I think the valuations that the market cap is about 750 crores, and the report or the news item suggests that the promoters, one of the promoters or the promoters, which hold 67% stake or 64% stake, may be looking at about 600 crores for their stake. Now, conservatively valuing, if the news report is to be believed, the company at about 900 to 1,000 crores versus the current market cap of 750. Now, I asked this question in light of the recent surge that we've seen in dairy-related companies in a big way. Have you looked at Vadilal at all? And what, if something like this were to happen, is that something that could benefit the minority shareholders? If not anything else, then in the stock price?
Well, not looked at Vadilal specifically, Neeraj, but I'm not surprised with the valuation expectation, because not just dairy, all consumer names have been doing well, minus the small blip that you saw due to GST. And if this kind of development happens, of course, this is excellent for minority shareholders, because I think when deals happen at such valuations, it's only, I presume, it's either a strategic investor or a private equity investor. People who can actually get either majority shareholding or, more importantly, control of the board, who can drive major strategic decisions, not looking at the short term, are the people who can benefit in a major way. So minority shareholders anyway are dependent mostly, if it remains a listed company, would be dependent mostly on what happens on a quarter-to-quarter basis. And of course, when you buy a company for such top dollar valuations, there is something very strategic that you want to do, which may not really suit the tastes of minority shareholders. So both from the medium to long term, or I would say short to medium term perspective for minority shareholders, as well as the valuation that's available on the table now, if it happens at these valuations, is certainly good for minority shareholders.
Let's wait and watch. Anyway, so much more to speak about. Phani, stay on. But it's that time of the show when we get in our technical experts on board and try and figure out what are they doing in trade this morning. Mukesh Singh, Head of Technical Analysis at Nila Financial Services, as well as Vishvesh Chauhan, Head of Quantitative Research at Monarch Networth Capital, join us right now on the show. Good morning, both of you. Thanks so much for joining in. Mukesh, any trades on the index?
Morning, Neeraj. After this Friday's action, it seems that the longer-term uptrend has once again reasserted itself. And the pattern in weekly charts is that of a hammer. Buy will be signaled according to this pattern once Nifty starts taking out 10,345. And in that case, the target is expected to be seen around 10,525, 10,550. And if someone is acting on this trade basis, a buy of a weekly hammer pattern, then one is advised to keep a stop below 10,190, which is seen as a short-term support for the markets going forward.
Okay, now just before we get in stock ideas, and we'll get in Vishvesh's view on the index in a bit as well, but it's 8:50, so that time of the show when we get you our special segment, Bloomberg Edge, wherein the terminal throws up some very interesting data points on specific stocks, and Jayesh joins in with what the terminal is saying today about Yes Bank. Jayesh, good morning.
Morning, Neeraj. So I'm watching out for one indicator and one chart pattern that has come out on Yes Bank. Now, before we go into the stochastic buy signal that has been generated, a word on the candle sessions that has also, suggested a trend reversal. So you can see as of Friday's close, the session number 1 has been marked on the chart of Yes Bank, which suggests that there might be a possible, a reversal of the trend, and we could look at prices going upwards from here. Coming to the stochastic indicator, which has given you a buy signal, let's first have a look at how the stochastic actually works. So, it helps you to identify when the price move is overextended, and it also helps you to measure where the current price is in relation to the recent high or the low that the stock has, achieved. Few conditions that you have to keep in mind while using the stochastic indicator. So, overbought, is above 80 and oversold is below 20. And the crossover between the two lines which are plotted by the stochastic gives you a buy or a sell signal depending on the direction of the crossover. Now, going back to the chart of stochastic Yes Bank, that's where the buy signal has come in. So you see that the blue line has in fact crossed over the white line, and both these lines now actually have crossed above the green line, which gives you a confirmation buy signal along with the candle session also suggesting the same thing.
And have you back tested this?
Yes, Neeraj. So stochastic works exceptionally well when it comes to the buy signal on Yes Bank. The return generated would have been in excess of 70% in the last 1 year.
Wow. Okay. 76% in the last 1 year. That's the stochastic hit rate for Yes Bank. That's a fairly strong hit rate as well. Now, let me ask this to Vishvesh, because he's also got a strategy on Yes Bank coincidentally. Vishvesh, firstly, a very quick analysis of Yes Bank charts, and then do explain your strategy as well, a ratio spread on Yes Bank.
See, I think Neeraj, very well highlighted by your analyst on the Bloomberg terminal. I believe that technical indicators is one way to mitigate the sort of a downside risk, but at the same time, options give you an edge in terms of executing that large quantity somebody is willing to execute. So ratio spread is something, in my opinion, gives you that kind of an edge. So where you are expecting an upside, but you are expecting an upside capped, and at the same time you don't want to incur a debit. So if you do a ratio spread on a Yes Bank, where you buy a 1 lot of 310 call option and you sell 3 lot of 330 call option, your net debit turns out to be 0.50 paisa, which is credit in opinion. So 1750 is low. So you are executing this strategy at virtually no cost, and you're incurring some profit also. And if Yes Bank stays at the similar, you're not incurring loss. If it goes higher, you're not incurring at loss. And if it goes higher to 330, you're incurring a profit of 20 rupees, which in my opinion 6 to 7%. So this is a very good idea to play, where the upside, in my opinion, right now could be curtailed. Only above 330 we can see Yes Bank going up to 340. So that is, in my opinion, a very safe strategy. Buy 1 lot of 310 and sell 3 lot of 330 on Yes Bank ratio spread.
Okay, so that's an interesting strategy coming on Yes Bank. Mukesh, which stocks are you recommending this morning?
Morning, Pradeep. The stocks which I have covered are Adani Ports. It's a buy around 398, and stop is to be placed below 392, and target on the higher side is seen around 425. And the second stock which I have covered is Mahindra and Mahindra Finance. It's been hanging around all-time highs, and it seems that this particular stock can give a momentum trade to short-term traders. Buy is to be done around 434 kind of area, and the stop is to be placed below 427. Target on the upside is seen around 460.
And Vishvesh, your Plain vanilla strategies, a buy on a Tata Power and a buy on Max Financial today.
See, I think Neeraj, in a power sector, the one stock which was lagging for a quite while was a Tata Power. In fact, it was not going anywhere. But the recent data suggests that I think stock is ready to move much higher, and I think there must have been some sort of a fundamental trigger as well. So, in my opinion, it was a very long time. Folks, for 12 months, the stock was trading in the range of 86 to 78, and now when the stock is trying to move over 88, in my opinion, the stock is heading much higher. But for trading perspective, one can buy with a stop of 86. Target could be well above 95. I think in a power sector, Tata Power may outperform. Second is the Max Financial. I think this stock for quite some time was trying to consolidate in the range, and now probably it is appearing that the bottom is in place, and a very short term bottom is in a place. So with a stop of around 560, one can look to buy for this expiry. Target could be 600 on the higher side.
Okay, so that's a whole load of strategies, but Yes Bank would clearly be in focus. Remember, there's fundamental news backing it. IndianOpen and Yes Bank would be a part of the Sensex, and at the cost of two pharma companies, so do watch out for that. So pharma banking clearly in the thick of news. The other stock that is in news today is Larsen Toubro, not for really big reasons, Phani, but amidst guidance of a slightly muted order inflow in the second half, there is a reasonably large order that they have won. 8,600 odd crores. Now, of course, it doesn't move the needle too much on L&T, but do you think the market is pricing in a reasonable amount of muted order inflow guidance already, and therefore does this and some of the other factors make Larsen & Toubro and some of the other players a good investment candidate from a 12 to 24 month perspective?
Well, Neeraj, if you look at the pendulum of market sentiment on infrastructure, and L&T being a proxy to that, it's been swinging from one extreme to the other. So that actually can be seen in L&T stock price. It's been all over the place from 1200 to 1800 for the last 3 years. Now, the way to play L&T, to my mind, and I don't really know what market sentiment would be on this order inflow, and we hold positions in L&T. The way we play L&T is, it's a proxy to the India infrastructure story, maybe the best governed in that space, a large market cap, which means that it will always attract both foreign investors as well as marquee domestic investors. And then if you look at the execution capability of L&T, it's again one of the best, if not the best. So you can always debate till the cows come back home on whether 18p is expensive or 15p is expensive or whether it should be 20. But if that's going to be probably your only exposure in the infrastructure basket, because if you recall, all of L&T's worthy competitors are nearing bankruptcy today, right? So where are the options for an investor to really take exposure to the infrastructure basket in India? Maybe an IL&FS transport network, but that's an asset owner. L&T is actually more of a contractor, and it's present in multiple segments of the infrastructure and capital goods segment. So if you are not very particular about where valuation should be, as sometimes analysts do get, I think L&T is something which is a must in your portfolio. And I do believe that over the next 3 years, they can clock 12 to 15% growth both in the top line and bottom line. Now, whether that happens in the third year in the form of 45% growth or it happens linearly, I do not know, and I don't think anyone has a way to know. But with that growth outlook, I think the valuations are pretty reasonable.
And are you bullish on aviation, looking at the growth numbers, 10 million plus for the second time this year?
Well, for some time now, they have been getting their act together, barring the shocker from Indigo that you saw a year back when they were unable to pass on the oil price hike. The only joker in the pack there, Pradeep, is oil. And if oil goes to $70, then I think tactically it's a good time to be underweight. But the way the industry microstructure has been panning out, now the market shares seem to be well settled. There is no mad competition to gain market share. This is always good news from both the industry incumbents as well as investors' point of view. So this is a space that longer term investors can start considering, with the exception that oil is the only spoiler in the party. But more or less, I think as and when, if you believe that oil will settle somewhere around below $70, I think aviation is something that you can take a longer term exposure to.
Chalk and cheese though. There is the largest player, there is a mid-sized player by market share, and there is the one which is starting to find its wings in a big way. Would you bet across the space, or would you prefer one over the other?
Well,
not a recommendation by any means.
Obviously, usually the way to play such themes, and that also depends on how much conviction each investor has. For a very long time, I had been one of the naysayers on aviation, and since I've started dipping my feet here, although we have not started buying, but started having some conviction, we would rather go for the leader as well as the challenger. We would not like to take exposure to someone who has less than 10% market share, because then what starts happening is the possibility of cash burn starts increasing that much higher.
Okay, Phani, just hold on to that thought. We'll actually probe that in a bit detail, but I think Phani kind of gave out his thoughts per se. But this is what the markets are likely to do. Just 9 seconds to the pre-open session. And we'll likely start off on a flattish note, maybe marginally higher, but let's wait and watch. The SGX Nifty indicating about a 10-point downtake. We won't have a 1% uptick for sure, but let's look at specific stocks. 3 or 4 of them. Can't not start with Biocon. That one is arguably the stock of the morning, and let's see if that is reacting in a big way. Maybe not 10%, but actually let's wait and watch. You never know. This is, as we heard Kiran Mazumdar-Shaw as well say, this is probably the biggest piece of news. So watch out for Biocon. Strides and Erin should also come up on your screen. Strides in particular. The deal not done at the best valuations, but it helps Strides pare down a little bit of debt to the tune of 400 crores. I think that's the stated word that they gave out. Strides should be in focus. It is about 3.5%. That's okay. And then the large ones, IndusInd Bank, Yes Bank, Cipla and Lupin. Both IndusInd and Yes Bank make their way into the Sensex. Cipla and Lupin exit. I don't know if it really brings about a material change today itself, over the course maybe, but and that too in a minor way. But yeah, a sentimental reaction nevertheless on all 4. The other 2 in the green, the 2 pharma stocks marginally in the red.
Interestingly, Wockhardt and Sun Pharma also indicating an open up with 7 to 8%. I'm not sure whether that will sustain. Tata Global is likely to open higher by 4%. Tech Mahindra, Hexaware, these are 2 IT stocks which may open with gains of 2.5 to 3% in today's trade. If you look at on the negative side, what has really corrected is Shree Cement, which is down by around 3% in pre-open, and some of the PSU banks like IDBI, Indian Bank, Bank of India, which may open lower by 1.5 to 2%. That is the early indication from the pre-open course action.
Well, let's get in Samit Sarkar, who joins us with the big brokerage calls of the morning. Samit, good morning yet again.
Good morning. So on the big brokerages today, first we have a CLSA on Bharti Infratel. Now they have maintained their buy rating with a target price of 490. Now they're saying that the exit of smaller operators and slowdown in Reliance Jio's rollout could hurt the tenancy growth of Bharti Infratel, and they're saying that every 1% hit of tenancy estimate could impact the FY19 and FY20 revenue and EBITDA estimates in the range of 0.6 to 1.4% for Bharti Infratel. On Industar, they're saying that with Bharti Infratel having the first right of refusal, the Indus Infratel deal is unavoidable. Now Vodafone had valued its 42% stake of Industars at $5 billion, which brings Indus enterprise value to $12 billion, which means that Bharti Infratel's own valuation could boost by around 10% according to CLSA. Now, however, going forward, they are saying that there could be a growth in tenancy on the back of Bharti Airtel and Reliance Jio's rollout. However, they are positive on the stock on the back of growth, dividend, EBITDA CAGR of 9% over FY17 to FY20 and a possible merger with Industars. Second, we have a Citi on Maruti Suzuki. Now, they have maintained their buy rating with a target price of 9,400. Now, Suzuki Motor and Toyota have signed a memorandum of understanding to introduce electric vehicles in India by 2020. Now, Suzuki will be manufacturing these electric vehicles while Toyota will be providing the technical support. However, so far Maruti's role in this is not defined, but according to the brokerage, Maruti could handle the marketing and distribution along with the after-sales service for this electric vehicles. Now, this development is a big positive for Maruti as it will help rapidly close the first mover advantage that Mahindra & Mahindra has so far. They are also positive on Maruti on the back of its improving product mix, gains in market share and healthy EBIT CAGR of 22% over FY17 to FY20.
Thanks, Amit, for all these details. Phani, what's your view on Maruti?
The second most expensive stock in the world, Pradeep. Well, again, Well, there is absolutely no doubt on the fundamental attributes such as market leadership, etc. But I would have hesitation in really buying something like a Maruti at this time, north of 30 times. Considering the fact that over the next 5 years, the CAGR growth, even assuming that the market microstructure remains the same, is not really going to be anywhere close to where the valuations today are. So I think it's some sort of a, since the only four-wheeler stock is available, some sort of a scarcity premium out there. But over the next 3 to 5 years, I think I don't think I would be comfortable at this price. Disclosure being, we hold Maruti in our portfolios, and we had entered at very, very good prices, and we continue to enjoy the ride.
So this may not be a fresh buy according to you, but is it a hold?
Absolutely.
It is a hold for the foreseeable future.
Absolutely.
Because, you know, off late they've been constrained by capacity. Once that comes on stream, their volume growth, which anyways is not too bad, will actually start improving on a month-on-month basis as well. So that's something to look forward to in terms of a trigger for Maruti, right?
Definitely, and probably that is what is driving the brokerage's view and fund managers' view as well. But look at what's happening to Nifty. 10,291 is the level I see on SGX, whereas Nifty as of now is indicating 10,294. Now remember, on Friday when market closed, there was a premium of 25 points. It contracted from 40 points, but still a 25 points premium. And SGX Nifty actually indicates the futures level, which means the Indian markets are at least 25 points ahead or are higher compared to what SGX Nifty was indicating. So a lot more positive when other Asian markets are not doing that well.
Yeah, well, let's bring up, 5 minutes actually. Let's just get Biocon up on the screen once again. For a lot of viewers who are joining in right now, the US FDA has given a clean chit to the Bangur unit of Biocon, and that stock is likely to start off about 3.5% higher, 408 or 409 currently. Mukesh, just a quick word here on Biocon on the charts. At 408 or 409, is it a buy call? Fundamentally, there is positive news flow. Can it do more from these levels?
Neeraj, it can very definitely test these areas around 430-35. But if you ask as a fresh buy, then it's the stop is quite far, around 370-75. So the risk reward does not favor this kind of a buy trade. But if someone is holding, then one can wait for a push around 425-430 to book profits.
Okay. Well, let's wait and watch. The other brokerage note, Pradeep referred to Maruti as one. I think CLS on Infratel, and amongst other things, they are saying that the Infratel and Indus deal is inevitable. They maintain their buy call on Bharti Infratel with a target price of 490. That stock is up about 1.5% or 1.25% in trade. So that's not starting off on a poor note at all. Any thoughts here, Phani, Infratel?
Well, not certainly on Infratel, Neeraj, but on the larger telecom tower segment, it's very interesting that the telecom tower segment today is enjoying probably north of 20% return on capital, while the largest tenants are probably 5% return on capital. Now, this is a dichotomy that doesn't persist for a very long period of time. Now, something has to give way. Either the tenants have to prosper more. I don't think that can happen over the next 2 to 3 years. And you already see extreme consolidation in the telecom segment in terms of both wage bill rationalization as well as compression of other costs like network costs, etc. You're already seeing, by the way, in the telecom tower segment that the tenancies are reducing because of consolidation. I think we are not very far off from the time that the rentals will start getting rationalized. You cannot have a situation where the asset owner enjoys 20% plus ROC and the tenant is at 5% ROC. I think there has to be a convergence some point in time. I don't expect the asset owner to come below 10%, but over the next 2 to 3 years, I'll be extremely surprised if the ROCs of the asset owners do not compress. So broadly, I'm not very comfortable with the entire construct of that space.
Okay, so that's the view on telecom and telecom tower companies. But are you holding on to any of these recently listed insurance companies? HDFC Life was the best listing, of course, on Friday.
No, not yet. We're yet to understand that industry meaningfully, Pradeep. Right now, that business is being, valued in a plain, is being seen as a plain vanilla treasury operations game by many investors. There is much more to it. As I said, we are yet to meaningfully understand that business, and once we do, we will take a view on that.
Yeah, but I think Pradeep puts that point into focus. HDFC Life, Standard Life, it's probably been the one insurance IPO which is making money right now, right? I mean, of course, ICICI has a different kettle of fish, but that got listed last year. And these recent listings, insurance has not made money, except this one, 20% on Friday. Let's wait and watch if there is more in store. Motilal Oswal certainly seems to be believing so. They believe it's another compounder, quality franchise at attractive valuations. Well, let's wait and watch if indeed.
Well, you still do not have the final matrix in place. The persistency ratios are nowhere where they should be, right? So you actually at this point in time do not know how the Indian insurance market is going to shape up. You know, with this kind of persistency ratios, there is no way you're going to pay that kind of valuation. And the customer acquisition cost continues to be very high.
Let's wait and watch. But minutes away from market open, the pre-open rates have settled. Let's just bring up what the indices have done at the end of pre-open session. We'll have a start which is marginally in the green. So yeah, about 3 points higher, but this could go either direction, quite frankly. Let's wait and watch. And from among stocks, I think Larsen Toubro is the one which is, on the index at least, making the biggest move. But let's tell you all that you need to know to stay ahead in trade today. IndusInd Bank, Yes Bank to join the Bombay Stock PSE Sensex, while Cipla and Lupin will exit from 18th of December.
Mayur Uniquoters, Eris Life Sciences reported strong results over the weekend. Meanwhile, S. Chand reported a weak number.
Stride Sashun will sell its India-branded business to Eris Life Sciences in a deal worth 500 crore rupees. The stock up 3% in the session today.
11 stocks joined the FNO ban. DLF, HDIL and Indocount enter while India Cement exits.
Vadilal Industries promoters may put India's oldest ice cream maker on the block, as per an Economic Times report.
And the Times of India reports that the government may consider bringing down the GST rate on white goods to 18% from the current 28%.
Well, that's interesting. We're talking about all the newsmakers in the morning today. Vadilal may well emerge as the one. Phani, I know we spoke about this earlier, but for a benefit of a lot of viewers who tune in post 9 a.m., wondering what's happening, what to do, there's an Economic Times report which says that promoters may be looking to sell stake in Vadilal at presumably a higher valuation. You would presume that net should be positive if indeed a 64% entity, which is the promoter entity, which is in a bit of a dispute over the years, eventually sells out to a large institutional player.
It's certainly going to be positive because there was no strategic focus exactly because of the internal issues. And we are yet to know whether it goes to a strategic investor or a private equity investor. But whatever it is, I think the outcome will be better than the current status quo. And hence, it's a good deal for minority, good opportunity, I would rather say, for minority investors.
Okay. So that's the call here. Well, if you look at the index now, Nifty has settled at 10,287 in the pre-open, marginally higher, just 3 to 4 points. The Nifty Bank is also flat. Vishvesh, are you going to trade any of these two index today?
See, I think Pratik, from last couple of weeks, we've been having a very simple stance on the index, is that on a Nifty around a 10,300, we would like to short the 10,300 straddle. And if it comes to around a 10,200, probably we want to do a ratio spread of buy 10,200 and sell 3 or 2 lots of 10,500. Now, as far as the very short term is concerned, I think as long as 10,230 is held on the spot, probably we would like to buy on decline for the simple target of 10,450, 470 on the higher side. Bank Nifty, we are more comfortable because the Bank Nifty has broken above the consolidation range, and I think in a very shorter term you could see a target of 26,200 sort of a thing. So if it opens soft and around a 25,600, it will be good buy to me in a Bank Nifty.
Okay, a minute and a half left before the markets kickstart trade. We've highlighted all the key stocks of the morning. Remember, cement stocks will be under pressure today because of two reasons. One is the pet coke ban for northern players, and then of course the cement price rollback as well. So that is something that investors should well keep in mind. Ultratech likely to start off as the top loser on the Nifty. But if you had to nail it down to that one top trading idea for the day, which one should that be? That's what we ask our experts now. Mukesh, to you first, your top trading call for this morning.
Neeraj, I will go with this Adani Ports idea. It has to be bought around 398, and if it is opening higher around 400, then also one can buy. The stop is to be placed below 392, and target on the upside is seen around 425 to 430.
Okay, so Adani Ports from Mukesh's end. Vishvesh, your top call for the morning.
I think Tata Power with a stop below 86 target 96 on the high side.
Okay, so these are the top trading bets coming from our experts, and as we look at it, 40 seconds to go. Key stocks to watch out for will be Pharma and also L&T, which has won a really big order, but it has come off a bit in pre-open, Neeraj, if you look at it now.
Okay, let's wait and monitor that as well, Pradeep. Thanks for that. Just about 24 seconds left. We'll start off marginally in the green. 10,287, about 3 odd points higher for the Nifty. The key remains, of course, what happens to some specific stocks, as is always the case. In today's session, more so for the pharma pack, as well as for the cement players. The cement is likely to stay subdued in the session today. But here are the first rates. This Monday morning, the day after, the trading day after, India's rating got upgraded. We're starting off as flat can be. Even for the banks, there's hardly any movement. So about 15 odd points for the Nifty bank. The Sensex about 34 odd points. So there's hardly any movement that we're seeing in any of the benchmark indices. Just get the heat map up and show you the flavor. I would reckon the mid caps too are flat, so not quite marking that. But yeah, it's even Stevens with the L&T starting off much better, and cement certainly looking like being under pressure. Ultratech is that mention out there, which is down, and Ambuja is down about a couple of percentage points. So clearly the newsmakers are moving around in the session today. Let's bring up some specific names and try and show you what's moving around and what's not. So firstly, the index inclusions and exclusions. So the Sensex inclusions reacting, well, Yes Bank reacting ever so slightly, IndusInd Bank not so much, but about 1% higher for Yes Bank. Let's bring up the exclusions as well and see if they are reacting in the red, about 1% lower. So not too much of a reaction, but you didn't expect too much of a reaction in which is on day one. But this is an indication of which way the index weightage is moving, in favor of BFSI, out of favor of pharma. The Bengaluru's plant for Biocon has gotten a clean chit, and that stock is starting off higher, 5% higher in trade. So that's a big start for Biocon in the session today. Good move there, 415. The pet coke ban will impact a bunch of players. Shree Cement spoke to us, remember, and told us the margins will come under pressure, down about 3.5%. In fact, now close to 4%. And remember, this is slightly illiquid. We'll probably mark some of the liquid names as well. But starting off on a weak footing is Shree Cement as well. And last but not the least, just want to mark one company, and that's Bharti Infratel. CLSA bets on the Infratel Indus deal. They say it's inevitable. They've maintained the target price at 490. That stock is starting off about a 2.5% higher in the session today. What else, Pradeep?
Navkar Corporation, if you look at it, up 5.5% with some 10,000 shares traded so far. You also have Jacob moving up around 4%. That this could be an impact of the Trans Harbour Link actually in Mumbai, because Jacob has several assets on the other side of the sea. Himathinka CETA is up 3%. You also have HDIL, VRL Logistics. In fact, several logistics stocks are doing well today. All cargo also up around 2%. DV's Lab has also opened in positive. On the negative side, you have HEG, which is down around 4.5–5% now. Well, if HEG is down, there could be an impact on graphite as well, down 1.5% as well. Shree Cement is now down 3.5%. MMTC has corrected a bit. JK Lakshmi Cement, another cement company, other than India Cement, is quoting weak at this point of time. Also, Jubilant Life Sciences has opened weak, down by 2.5%. Reliance Nippon Life Insurance is also opening down, and so is Reliance Capital. So ADAG stocks remain under pressure even this morning. So that's the kind of market open numbers that we have.
And 3% uptick for Vadilal, not too much. Volumes are a bit thin as well. Just keep that stock at the back of your mind. However, getting final thoughts from our experts. And Phani, while we've asked you about a bunch of pockets, we even asked you about what is it that you are betting on currently, a theme that you believe could make money despite the market valuations looking so rich.
Well, most of the mainstream themes are very well discovered. So right now I'm very keenly observing the hotel industry, Neeraj, because I believe that it is coming out of a multi-year down cycle, and over the next 3 to 4 years, maybe around 2000, heading up to 2020 or 2021, I think the return ratios will probably triple or quadruple. That's the kind of profitability that we are seeing, because you are looking at supply probably growing at around 5% and demand despite the bad years from 2012 to 16, even that time demand held up in double digits. So I expect that demand will continue to grow at around 12%. You're already looking at a 63% occupancy rate. The peak occupancy rate that you saw in the last cycle was around 73, and there is no reason why we can't hit that in the next 2 to 3 years. And most of these hotel stocks are available at quite an attractive valuation considering the outlook 2 to 3 years down the line. So it's not a buy recommendation, but that's a space that looks pretty interesting at this point in time.
Okay, Phani, we'll leave it at that. Thanks much for taking the time out and joining us and giving us that perspective. Just keep in mind, J Corp has a stock. That one has moved up on about 6.5 lakh shares already, up about 7.5% in the session today. So do watch out for J Corp in the session. But speaking of big market voices, Kenneth Akinteve, Senior Investment Manager at Aberdeen Asset Management Asia, believes that Indian equities are slightly expensive and that there is other ways to play the India story. Hear out that conversation that we had with him earlier on in the day.
In the near term, you may get a bit of positive sentiment both in the equity market and bond market, but I think from our perspective, this ratings upgrade has been a long time coming. So Moody's is a little bit of ahead of the curve. Obviously, they've had India on positive outlook for a while, but I think the market, both in terms of equities and even the bond market to some extent, has been well ahead of the rating agencies. I think they've generally been quite slow in their approach to upgrading India. We've had almost 4 years of persistent and consistent reform. And obviously there's two other rating agencies, S&P and Fitch, and these rating agencies don't even have India on positive outlook, let alone are ready to upgrade them. So if anything, I think the rating agencies have been a little bit behind the curve, and the market has been well ahead of the rating agencies. So it won't make a material impact in the medium term. I think what will be the bigger drivers of the market is continued commitment to pursuing very key reforms, of which we still need to see a few more.
So yes, well, you can argue that rating agencies typically have been accused of doing rear view mirror driving. But a lot of people also say that if you look at the rationale that Moody's seems to have given, they are also taking a bit of a forward view, because in their assessment, they are taking into account that oil will stay at a 40 to 60 band. They are taking into account that the reforms that have been put in place in India will show material impact over the course of the next 12 to 18 odd months in print as well. And of course, any further upward pressure to ratings will only be dependent on a slew of measures, including the investment cycle picking up. In that sense, do you think that provides a bit of a comfort to, say, fixed income investors, because that's an area that you handle, fixed income investors about their investments into India? Because while the investments were very, very strong for the first half of calendar year 17 into India, the second half has seen a bit of a trickle down into Indian bond markets, also maybe because of capital controls.
Yeah, I mean, there have been a number of factors. We've seen since June inflation bottomed, and as widely expected, base effects easing off. We've seen inflation creeping back up over the last few months with the impacts of demonetization and more recently the goods and services tax. That has caused a little bit of a supply shock in the economy, and because of that negative growth impact, the market did expect that the government potentially would come out with some fiscal stimulus, which we haven't really seen materializing actually. But there are a number of other factors which have also been weighing on the bond market as well. Obviously, the central bank has been doing open market operations that have been impacting the willingness of domestic investors in particular to invest. And as you alluded to, obviously the openness of the market to foreign investors, those quotas have been fully utilized almost, and so you haven't really been able to see such strong foreign investment flows. So I think a combination of these factors has obviously put the market on the back foot. To put it into a bit of context, however, you are in a fairly seasonally weak time for emerging markets generally, and if you compare India to some of the broader emerging markets, actually you've seen somewhat better stability in bond yields over the last sort of month and a half. You've seen fairly marked rises in things like local currency, emerging market debt yields in particularly sectors like US high yield, which has been another popular market. All these areas of the global bond markets are selling off quite markedly. So to be honest, the sell-off in India is not too marked in contrast to that. And generally, you still see better volatility and risk-return characteristics, not just from the bond market, but particularly from the currency as well. At 5 to maybe 5.5–6% volatility, the rupee is still one of the lower volatility currencies in the emerging markets investment universe. And for us, that is a very important point, because what we're trying to do is construct portfolios that have very good diversification and risk return characteristics and are somewhat immune from some of the potential exogenous shocks that we could be seeing over the coming quarters.
Like you mentioned, bond markets were probably ahead of the curve, and they were pricing in a better rating for India ahead of the ratings that were actually recommended by the agencies. What does it mean now? I mean, if bond prices or the yields were already in sync with a higher notch on the rating scale, when the rating upgrade really comes, will that allow for any further lowering of the yield on Indian bonds or the risk premium on Indian bonds?
Yeah, we may actually see the market find a bit of stability, because if you think about it, commodity markets are already correcting. You know, oil prices have actually already come off their highs. I think if you look more broadly than that, some of the other commodities like base metals are also correcting. And if we look forward to some of the risks that we may be seeing going into the start of next year, one of the big ones for emerging markets is China. And while we're generally quite positive in the transformation and transition in the Chinese economy, it is likely to be characterized by some stricter policies which may begin to slow growth, and we are seeing some pressures in the on the property market. And what that may mean, if you have a correction in commodities, is some degree of negative impact on broad EM, but that would be a positive for India, which generally does better when commodity prices are softer. So I think maybe some of these factors are perhaps more relevant for India. Another big one will be the review that we will get in the first quarter of next year, where the policymakers are assessing the FPI, or foreign portfolio investor framework, and will be deciding on what degree of access they could increase in both the government market and the corporate bond market. So for us, that's an important one. Just to put it into, again, some context, if you look across global emerging market local currency funds, as much as you probably find investors talking about India, the weight of India in these funds is literally about 1% or maybe even slightly less. And for what is one of the strongest reform stories anywhere in the emerging markets, if not in the world, and for a market that can seriously improve your risk return and diversification characteristics in your portfolios, 1% is way too low. They should be running much higher allocations, and obviously to do that, they would need greater access to the market.
And also, I think what attracts money from world over is growth. Now, if you look at this rating upgrade, probably we are looking at a 6% GDP growth with 3% fiscal deficit. That is the target, and maybe 4% inflation. But that may not really be, as per the potential growth of India. So, while the government is trying to be prudent fiscally, and that is probably helping us get a rating upgrade, do you think we are kind of stuck in a low-level equilibrium?
So I think there are a lot of interesting things to come in the coming years. You know, the transition in the Indian economy and in politics and in policy has already been, fascinating to watch and really quite encouraging. But some of the most important transitions are yet to come. So some of the biggest infrastructure projects going on anywhere in the world are happening in India right now as we speak. So these very big investments into, the north-south industrial freight corridor, east-west transportation systems that are going to begin to start tying up the entire country. You will see massive improvements in productivity, drops in logistics costs. And when you combine that with policies like the goods and services tax, I mean, these factors alone could add several percent in GDP in the coming years. Now, it's not something that happens in the near term. You will only start to see some of these projects being completed starting in, say, 2019. So we're talking more in the medium to long term. But nevertheless, this does improve the outlook for Indian growth. And of course, you're also starting to see a lot of traction in new industries as well. Some focused on technology, some that will be focused on things like logistics and warehousing and new opportunities like that. And again, at the same time, this is happening at a time when the policymakers have actually opened up the economy to greater foreign direct investments. So you will be able to see a greater weight of foreign capital coming into play. Some of these emerging stories as well. So I think the medium to longer term outlook for India is still quite encouraging. Obviously, there's still been a little bit of trepidation from the domestic private sector to also participate in that. And obviously we've still been seeing fairly weak private investments and private credit growth. But I think over the medium to long term, as some of these trends start to play out, you may begin to see also greater participation by the domestic private sector as well. So we're pretty encouraged by the longer term outlook, and still think there's a lot of opportunity in the economy and market.
The last 3 months undoubtedly have been a story of domestic flows supporting Indian markets. FI flows have been absent from the equity markets for sure, and I can understand in the debt markets we've breaching limits or very close to limits, so the flows would trickle down. Would calendar year 18 be more a repeat of calendar year 17 in that flows will restart from the FI end, both on the equity and the debt markets, starting the first month itself?
So from the bond market, it will really depend on to what extent we see access to the market being facilitated. There are obviously some things that are already in place to do that. So obviously we are in a transition ever since 2015, whereby the cap on government bonds is being increased from 3.5% to 5%, which will be completed by March 2018. So that does give us a little bit more increased access and potential to invest in the market, but it's still a little bit restricted. And obviously on the corporate bond side, while there have been some easing and greater facilitation by moving some of the Masala bonds out of the corporate bond quotas, there's still a bit of restricted access. So our ability to increase our flows into the market are kind of restricted from the bond side by the capital controls. On the equity market, obviously there's no such restrictions. The one thing I would say is that the equity market optically does seem a little bit expensive. You're trading at 25 times PE, if not slightly higher. So clearly a lot of good news has been priced into the market. The equity market for sure has not been the only way to play the India story, even though this has been one of the most popular ways. But if you look at a 3-year return, actually you'd have got better returns from investing in the bond market, close to a 30% return or 10% annualized. That is higher than the returns you'd have gotten from the equity market. And don't forget, your volatility in the bond market is only about 5%, which is half to a third of the volatility of the equity market. So I think there are still opportunities for investors. There's some constraints on the bond side, and still opportunities in the equity market as the economic story plays out. But investors do have to be mindful of what kind of risk they're taking, and in the current environment and environments we're going to be seeing in 2018, there is a choice to be made between taking that exposure via bonds or via the equity market.
Okay, and of course we'll make you hear this conversation a bit later on in the day as well. I think one key thing that came out when we spoke to Aberdeen is when we asked him about whether any kind of fiscal slippage, a temporary and a transitionary one at that, would be priced in by the markets, both the equity and the bond markets, and they certainly seem to believe that that is something that the markets would take in their stride. So large investors seem to be believing that, in fact, Aberdeen said that they are already pricing in that there will be a bit of a slippage when the budget announcements come in this time around. Rakesh Jhunjhunwala on Friday spoke about the same as well. Let's wait and watch if the equity markets, don't quite know about the bond markets. Ira would speak more about that. But the equity markets, most investors seem to be believing that they'll take in their stride if there is an announcement which prices in a small fiscal slippage as well. Let's wait and watch. Okay. On to our next discussion. And online broking firms are slowly garnering a bigger pie of the brokerage business in the country, as is evident by the growth share numbers as well. And while convenience is one of the big factors, another distinguishing factor for most of the players is the comparatively lower brokerage fee charged by them. In fact, if you speak to users, they would say that that was one key reason which made them move from where they were to the current platforms. And of course, then the technology reimburses any kind of confidence that customers have in these brokerages. So can the edge be sustained? And what are the hurdles that some of these companies could be facing? To talk about that on the eve, or rather, but 2 days post the listing of 5paisa.com as well, we have the CEO of India's only listed online broking firm, that is 5paisa, Prakarsh Gagdani, and the co-founder of Zerodha, Nikhil Kamath. Gentlemen, both of you, good morning and thanks so much for joining in this discussion. Prakarsh, let's start off with you. Recent listing as well. A bit of a dichotomy about the discovered price within the exchanges, but that's not the scope for this discussion. The scope for this discussion is the growth rates that brokerage firms like you, Zerodha, and the others are seeing, and whether these are sustainable over the course of the near term.
I think online broking space and the kind of fintech space that we are into is at a very nascent stage. And we are seeing a lot of traction. So it is definitely sustainable over a longer period of time. At least for the near future, I can see that it is definitely sustainable, because just a start, people are getting to know about the online broking space and the fintech companies who are now offering practically at, like a company like ours is just offering at $10, which is almost 98-99% cheaper than what is available in the market. So that's a huge advantage for a retail investor. So we're seeing a lot of shift towards this business, and definitely this is sustainable over a longer period of time.
Nikhil, good morning. And you've been around for a while, and we've spoken in the past about how the platform was attracting more and more people to not just the basic business, but people talking about other businesses coming in as well. The basic question is, the meteoric growth rates that companies like you and 5paisa have shown in the recent past, for how long is this sustainable? I think Prakarsh said that near term he certainly sees to be sustainable. How long is this near term?
I think the penetration of stock markets in India is still in the very early stage. I think less than 10% of our population even has access to stock markets. And as this number grows with more people coming into the banking umbrella, we will only see more and more people, drive investments into stock markets and other instruments like that. So I think there's a long way to go. I think we are at the very beginning of something which is a lot longer.
Yeah, which I'm sure of. Okay, let me rephrase my question. I'm sure that the market share gain game and the penetration game is here to stay. But the same question to both of you. The question really is about the growth rates. Now, in your business models, I'm sure you're factoring in what's the quantum of growth that you will see for the next 1 year, what's the CAGR growth that you will see for the next 3 years or next 5 years. Are there estimates they are putting out in the public domain as well about the quantum of growth to your investors if you're putting those out? Nikhil, let me start that question with you first.
Well, we've been growing at over 100% every year for the last 8 years, and we see that trend continuing. For the next year, we expect the same level of growth. In fact, for the next 3 years, we expect the same level of growth.
But on what base, the same to both of you, what are the numbers you're doing? Are you counting in terms of accounts? If it is in terms of accounts, so what is the base on which you're growing 100%?
Well, in terms of account, we now have about 5 lakh clients, and hopefully we are planning to hit 1 million by sometime next year. That is the pace of growth we are seeing month over month right now, and if it is going to continue, we should be there.
Prakash, what are your base number of accounts?
We are right now just a 20-month-old, so we are just around 25,000 customers, but the growth rate is almost 80 to 85% quarter on quarter right now. So we definitely would be catching up past 100,000 customers very, very soon.
Small numbers, right?
That's a small number.
So the money you make is on volume, I assume.
Absolutely, absolutely.
So you would need these volumes to grow multi-fold.
Correct.
For you be able to make any sort of serious money out of a business like this.
I absolutely agree with you. But if you see digital space, it is like that.
I know.
On an offline space, to get to 100,000 customer or 1 million customer used to take about 15, 20 years. Now that's not the case. I mean, you can have maybe a couple of years and then you have a player in the same zone, because that's the power of digital. And why I am so confident about is that see, if you said the two sides of the story. The first side is the lower penetration of the demat accounts, and that's not been just now. It's been since ages, and we've been talking about this is hardly 1% or 2% that of the total population is actually having a demat account or approaching financial markets. But I think that is changing now purely because of the kind of internet penetration that we have seen in last 12 months, the kind of smartphone users we are seeing. So we have almost 70% of the customers coming from smaller towns where you don't have an access to a bank or a financial institution. So that is that gives us a confidence that it's just a start and it's a long, long way. You won't even see the kind of...
That story holds true for all Indian financial services,
It
right?
goes through,
Okay, so I have a more
absolutely.
specific question to both of you actually. So what is the nature of the clients that are coming in? Are these first-time equity traders or are these people who are actually downgrading from having worked with a brokerage which was charging them a lot more and hence are now thinking that your platform offers them more value because they don't have to pay the fee but they can transact as much as they want? What is the nature of the clients?
So it's a mix of both, but largely dominated by people who are the first-time investors. They're new millennials because they're coming to the financial market for the first time, and there are a lot of people who are coming to the internet for the first time and approaching us. So it's more skewed towards the people who are coming as a new millennials.
Don't you think that's a risk, Neeraj? I mean, if it's the guys who are sort of biting into this for the first time, then it's not the value proposition which is drawing people into these online trading platforms. I mean, I wonder if it is.
Well, so two ways to...
I'm sure Nikhil will
No, okay, so yeah, maybe let's get in Nikhil's thought first before we kind of give our editorial judgment as well. But Nikhil, you've had a history of 8 odd years now. Is the nature of customer acquisition changing ever so slightly? Because one would presume that traders from a bulk, but are new long-term serious investors into your mutual fund products or otherwise also increasing in a big way? Has the nature of customer acquisition changed in the last 6 months?
Well, the goal has been to try and get new people who have never invested into stock markets and let them begin the process of investing. I think we have a mix of people who have switched from other brokers because we've been around for a while, and 8 years, a lot of people have switched from traditional brokers who are more expensive to us. And now we are seeing, with the birth of all kinds of technology that we've built around our trading platforms, people are coming to us more for that technology rather than the price alone. So you might have somebody who comes to us because we have better charting than others. You might have somebody who comes to us because we have better research than others. So even though we began as a no-frills discount broker, the new client acquisition is happening a lot more based on technology now, for us at least.
Okay. And Prakash, I would presume that's the same for you as well. A lot of people coming into technology. In fact, I've seen day traders speak volumes about the kind of ease at which the transactions are being done on online platforms as well. My question to you is, this nature of the customers, I would presume, who are coming in a big way, apart from being first-timers, would be the ones who are traditionally, as Ira said, transacting not really with the high-end institutional brokerages wherein the institutional investor requires the research from the brokerage house as well, but people who hitherto had no other choice but to go to a mid-sized or a small-sized broker and having to pay high brokerages, now opting to go on to your platform because he or she believes that he has the basic knowledge to be able to transact as his will and doesn't need the advice of his relationship manager, so to say, who's sitting out there at the brokerage.
I don't think the first point, which is a lack of choice, is actually the answer. People have choice. I mean, if you see even the full service brokers right now, everyone has an online platform. So you practically go on internet and you will find an option which are people like us and also the full service discount brokers.
Is that as cheap?
But yes, you're right. It is not as cheap. Rather, as I said, we are almost like 98% cheaper. So cost is one factor and very important factor. The other factor is the ease. That I have a mobile app which I can download simply, I can understand simply, and I can open an account online without any paperwork. I think the simplicity of the product, the price are the driving factors why people are coming more here. And also a choice of products that we offer. So it's not just direct broking. We also offer mutual funds. We are starting with our insurance platform, and then you have loans and all other financial products. So it is basically a financial supermarket available on your app, just like any other online e-commerce app.
Is that crowded? Is that pocket crowded? Because you clearly, Zerodha, etc., had clearly had this advantage of being able to get in customers and show them value because you're giving them the same or a better online experience at a fraction of the cost. What about the other product services? Is there a bite for the bullet for the same product?
There is definitely a competition, but I don't think so. It is crowded because what matters is exactly what you're offering and are you able to satisfy the retail investor what he's looking for. So you may have a lot of players coming in even now and maybe later, but what differentiates is definitely the experience. And I think that can't be explained, that why do you have only 2 or 3 people on online if you have an Amazon or a Flipkart, and why not others? You can't explain that. It's all an experience. So I think same goes for financial service providers like us on the online space.
Nikhil, you were mentioning in that previous answer that you're starting to sort of supplement your trading services with other factors like charting, research, etc. In doing that, are your sort of costs going up? In that case, probably tougher for you to make money, or you need slightly stronger volumes to make money?
Costs are going up based on, we've set up a tech team which is quite large right now, and the costs have definitely gone up, but the amount of incremental business the technology is bringing in right now definitely warrants it. And it's not just charting, but we have a lot of insight going into your trading platform, even in order execution, and how we can better manage your orders so you get faster executions on the exchange and stuff like that. So a lot of technology, not just one particular facet of trading. We're going around, now we are building a tool which will help you do technical analysis and automate on your own, without having any knowledge about coding or computers or anything like that.
So as we
so
get
all these
towards,
things together will definitely come together and improve the.
No, sorry, I was just saying that as you go towards this era of robo advisories, etc. I mean, do you think these platforms will sort of have to merge, because a standalone discount trading platform will probably not be able to do enough to get value out there for the customers, right?
True. I think we are transitioning into a process where it will be like a robo-advisory and all of these things merging into one platform. But we will have to evolve. The price was the draw initially, but it can't go on forever, because right now there are many others competing on price. So we have to come up with other stuff which will help us continue to garner new clients.
Do you agree?
I totally agree. I totally agree here. Rather, our platform is right now already bundled with all that. And
with the robo-advisory.
With the robo-advisory and other service offerings. So I totally agree with that. Yeah.
All right.
Great. Gentlemen, thank you so much for joining in and giving us a flavor, if at all, of what this platform entails and what's the way ahead, and all the best for the growth rates.
Thank
Prakarsh
you.
as well as Nikhil, thanks for joining in on this discussion. Well,
thanks a lot for having me.
Of course.
All right, that's stock markets. We'll transition into the economy. We haven't forgotten that on Friday we got that big rating upgrade from Moody's. Still a lot of debate on whether this was a backward-looking upgrade where the rating agency
objectively looked at what's happened in the last 2-3 years, would have agreed that the outlook should be reduced to stable, because you've had a number of institutional reforms, all of which will take a long time to have an impact on the economy. But I think what was most important is, if you look at their criteria, economic strength we do very well. Institutional strength, we're moving up. On the fiscal dynamics, we're still weak. But I think the part that kind of was the tipping point was the Moody's now believes that India's ability to handle event shocks has gone up. And there I do agree with them. The fact that we have a monetary policy framework means inflation will never be running at 8 or 10% for years on end. They're really hopeful we get the FRBM review, FRBM recommendations on a fiscal anchor. I think they're happy that fuel prices have been deregulated. So if oil prices go up, those are passed on, and there's a demand response. So I think ultimately two points I make. One is there is a greater belief now that some of the institutional changes in the last 3 years have better prepared India to handle external shocks and event risks, and that gives them more comfort that debt to GDP will not go up. It will come down slowly but not go up. And secondly, I think why now? I think it was the PSU bank recapitalization, to be honest. In their last assessment in August, they had said that a key ratings drag was risks in the banking sector, and I think once the government committed some capital, I think that was kind of the last uncertainty that was cleared away. So I think it's less relevant whether it's backward looking or forward looking. It's more a confirmation that we now have a set of institutional changes that make the Indian economy a little more resilient to shocks, whether domestic or external.
Okay, so that's a view you're taking on it. So, I mean, but they've listed out a whole host of reforms, Sajjid. Not all of them sort of go into that narrative. I mean, they're talking about, say, GST, Aadhaar, demonetization. I'm not sure why they put that in as a reform. But they just seem to sort of lump everything together and say that, you know, we're finding a reason to do this right now. But maybe that's what you're saying, that they had to move because they had a positive outlook.
Yes, and also I think, you know, ratings also tend to be a little more sluggish. I think like monetary policy, ratings agencies don't want to upgrade you one day and then 3 months later be forced to downgrade you. So they do tend to take a much more strategic view on things rather than a tactical view. I mean, one could be very critical and say, you know, fiscal risks have gone up in the next 3 or 4 months. We don't know whether this year's fiscal deficit target will be met. State finances at the margin have gotten worse. As a consequence, in their own estimate, debt to GDP is flat for a couple of years. Oil prices have moved up $10 a barrel. That constitutes a negative terms of trade shock. Why now? But again, you know, I will give them the benefit of the doubt because those are much more tactical issues. Those are 3-6 month issues. I think what the rating signifies or tries to convey is a much more strategic outlook that, you know, 5 years from now, we have a much greater conviction that India's debt to GDP will gradually be coming down. And I think a lot of this is predicated on growth. I think that's the key here, that they expect India's potential growth to go up in the 3, 4, 5 years so that even if fiscal deficits don't improve by as much as they want, debt to GDP comes down because of the denominator. So yes, they are making, you know, they are being forward-looking and saying all of these things eventually will show up in higher growth. We'll wait and see to what extent. I think next year's growth forecast is a bit ambitious. I think they expect 7.5% growth next year, which will take some doing. But again, I think they're taking a much more 3 to 5 year view, and they tend to move more sluggishly. So I will give them still the benefit of the doubt.
On that debt to GDP point, Sajjid, so you're convinced as well that we will start to steadily come down? I mean, I assume that if we accept the NK Singh committee report, we will have no option but to bring down debt to GDP towards 60%. But I think there's a long road until 2023 or something. I mean, we can understand it's stabilizing, but for it to come down means much higher growth, right?
You're exactly right. So I think that will take some time. I'm not convinced that debt to GDP in the next couple of years is going to come down rapidly, even if you don't count the PSU bank recapitalization, because ultimately, if you think of what's happening, the denominator is the difference is R minus G, the difference between interest rates and nominal GDP growth. Now, you know, a few years ago when we had a lot of financial repression and real interest rates were negative and sharply negative, you had this perversity where fiscal deficits are rising very sharply and yet debt to GDP was coming down because nominal GDP was running at 15 or 16% and real interest rates were so negative. That's gone away by choice, and that's one of the key positives in macro stability, that now the central bank will ensure that policy rates remain positive, which means by construction R minus G comes down. What that means is the numerator has to start doing more work. It means the primary deficit has to start going down sooner. I have no issues with the center. The center has been chipping away at the primary deficit. My concern really is with the states, that if you look at the trajectory of state finances in the last 3-4 years, those deficits have widened, and because there is no market feedback here, you know, borrowing costs for states are really not a function of what their debt levels are or their deficit levels are. There is no incentive for states to improve. So that is a concern for me, which is all the more reason that the center needs to stick to its path and perhaps overachieve in the next 3 or 4 years to compensate for the state. So I do think the fiscal is still a bit of a concern, and therefore what Moody's is banking on is, well, nominal GDP grows up enough that debt to GDP slowly comes down.
Sajjid, on the growth front, so I mean, you know, again, potential output, potential growth is you know, sort of been debated. The assumption was it has come down over the last few years. What is your own understanding of, you know, I don't even know how soon, or, you know, factors that will sort of push up potential growth rates for India?
You know, our sense is potential has come down a little bit, but not because of domestic reasons. I think, you know, some of the domestic reforms clearly will push potential growth up. I think, you know, to the extent that the GST, there's so much focus on the GST revenues, but really over the next 3 years, the fact that we now have a common market for GST means total factor productivity, allocative efficiency, where investment is set up, transportation costs, all these things come down. That pushes up total factor productivity. I think if we can recapitalize public sector banks and reform them, more importantly, that will improve credit allocation. So, I do believe domestic reforms are helping. The reason why potential has come down in India is the same reason why it's come down in all emerging markets. It's the fact that we will not get the export tailwind that we did in the mid-2000s. At that time, when India's growth was 9% for 5 years, it was because exports were growing at 18% a year in those 5 years, and that pushed up a potential growth in all emerging markets. The last 5 years, exports have come down to 3% a year export growth rate. So that itself will drag down potential growth by more than 100 basis points. So I think domestic factors do push potential up, global factors push it down. Ultimately, we'll need to find some new sources of growth at home in the next 3 to 5 years to compensate for the drag that exports in the global economy will be on India.
Sajjid, good morning. Neeraj here. If anything, if you hear the chatter over the last couple of weeks by global houses, including yours, I presume as well, the view on calendar year 18 global growth rates is much more lenient. Most people believe that if 2017 was a good year, 2018 could be better. You don't presume manufacturing exports or exports of any other nature would only stand to benefit in 2018 if indeed the global GDP is on its way up?
Well, I'll question the premise that 2018 will be better than 2017. For what it's worth, our growth forecasts are lower next year for a variety of reasons. If you just go region by region, China's growth clearly peaked in the first half of this year. We're seeing a meaningful slowdown in the second half, and we think that's really, if you look at the language of Xi Jinping at the People's Congress, it was very much now that event is over, focusing on the quality of growth rather than the quantity. We take that as being a sign that China would rather focus on lower growth but more balanced growth. More importantly, yes, the US and Europe have been positive surprises this year. But those are cyclical. If you look at the underlying supply side, our view has not changed. We do believe that potential growth in the US is 1.5% or less. Potential growth in Europe is going to be lower, which is why we take the view that you can't be in this Goldilocks situation forever, where growth is going up and interest rate normalization is so slow so as to not serve as a drag. We do think that inflation does pick up in 2018. Central banks will be forced to normalize faster. JPMorgan's own forecast has 5 rate hikes by the Fed between now and next December. We think the ECB will continue tapering. Ultimately, all of that normalization will have an impact on growth. So the combination of Europe and the US gradually asymptoting towards its lower potential, and China's conscious policy slowing, which then has implications for Latin America and Asia, make us believe that while growth will still be will be healthy, it's not going to accelerate further from the 2017 levels. I think the best is almost kind of behind us now.
Okay, Sajjid, since we have you here, slightly near-term question on India as well. We are running towards a new GDP number. We are running towards another policy as well. What's the slightly nearer-term outlook that JPMorgan has on India, growth and, of course, on the RBI policy?
I think the view is that growth will begin to inflect. We think the 5.7 was kind of the bottom of the cycle, but I think it's going to be a slow inflection point. So for what it's worth, our own forecast for the November 30th GDP number is in the low 6s, about 6.2 or 6.3. I think the second half you'll see higher growth, but we need to be careful how we interpret that. A lot of that is going to be a favorable base effect from last year. So just because growth heads towards 7%, we shouldn't claim victory on this front. The fact is there are a couple of headwinds for 2018. One is the deleveraging. I think now that the government's committed more capital, more and more companies will be taken into bankruptcy. This is very good for medium-term growth. In the near term, it becomes a headwind. And the second factor, which we're not speaking much about, is oil. We've been shouting from every rooftop for the last 2 years that much of the growth dividend we got in 2014, 15, 16 was oil going from 110 to 40. Now with oil prices mean reverting, back up to over 60, that will be a small adverse terms of trade shock. So we do see growth accelerating. I think exports will be better than last year. I think the impact of GST is going to fade, and that's going to help growth. But you're confronting these reasonably powerful headwinds as well. So for what it's worth, we do end up with growth at about 6.8% for this fiscal year that ends in March. But at least things get better from here on in, so that's a relief. I think on policy, this is very straightforward now for the RBI. Almost every indication would suggest that they remain on an extended pause. Oil prices are back up above $60. There's more confirmation about global growth and therefore global financial conditions normalizing faster next year. Some concerns on near-term fiscal. Current account deficit we know is on course to tripling from last year. All of these kind of risks move in one direction. So we think the RBI will be comfortably on hold for the foreseeable future.
All right, got that, Sajjid. Always a pleasure to speak to you. Thanks so much for making the time to speak with us this morning. That's Sajjid Chinoy with his thoughts on the ratings upgrade, but also a quick near-term view on India.
Yeah, but with that, it's a wrap on this leg of Indian Open. Keep in mind, cement is a sector that is in doldrums in the session today. But up next is the FNO show. Stay tuned.